everyone, welcome to our very first Lessonupsquad class. My name is Hina and I'll be the presenter for the course of your class. But before I start the class today, I have a very special message to everyone watching. So this is an initiative started by myself and my sister who will be providing the other topics in the other classes. And we started this initiative to do our part in this hard and trying times of the pandemic. Especially for the matrix, this is a very important chapter in your life, and we recognize that. It's almost a make or break situation, and we want you to realize you have enough resources and support around you. It's a cause very close to our heart, and we'd like to take this opportunity and dedicate our initiative to our teachers at Lodium Secondary School, our lecturers at the University of Pretoria, our family, friends, my parents, mentors, people I've worked with. Thank you so very much that you've made us capable to empower other people today. Remember, these lessons are free but full of value. The only thing we ask is that you subscribe to our YouTube channel, follow us on Instagram so that we can challenge other people to provide similar initiatives. Remember, the purpose of the initiative is to clarify difficult concepts for students with practical examples and logical methodology. Let's head to our lesson now. Our first topic of presentation is cash flow statement. So let's start with the basic. What is a cash flow statement? Cash flow statement is another accounting statement, just like your income statement or your balance sheet. A cash flow statement is required by the Companies Act. It's a legislation requirement to have a cash flow statement in your financial statement. A cash flow statement would tell you the movement of your physical cash, what's going in, what's going out of your bank, how you've made money, how you've spent the money. It tells the user of the financial statement about the liquidity position of a business. The statement only looks at cash, whereas other statements will include cash and accounting adjustments at times. As an example, let's look at the cash flow statement and the income statement. So cash flow statement will tell you the cash that you had at the beginning of the year, the money that came cash in your bank during the year, the cash that you've spent during the year will give you the cash at the end of the year, versus an income statement, which will include your revenue, that is not only cash, but also credit sales, as well as all your expenses that are payable, which gives you your profit. Let's also look at the difference between your cash flow, a cash balance, and a cash budget. A cash flow is the movement of cash, just like a river flowing. It's ins and outs of your cash. A cash balance is the value of the cash at any given point. So for example, if you've got 100 Rand in your bank account, if you get 500 Rand and you still spend 300 Rand, the 500 and the 300 are considered your cash flow. The balance that you get after spending the 500, the 300 is the 300. That is your cash balance at the end of the year. A cash budget, on the other hand, is an expectation of money that you have, what you will receive and what you will spend in the future. It's almost like a prediction. So why is the statement so important? Cash is king. Most users of the financial statement will want to know what happened to the cash. How was the cash earned? How was the cash spent? What is the cash left? The information provided by the statement helps the users to understand if they have funds to expand or grow. It helps the company also to understand if they have sufficient money to pay its expenses. The statement only looks at cash, whereas other statements look at accounting adjustment. Often accounting entries can make a business look profitable because it includes receivable and payable amounts. But a cash flow statement can give you an accurate picture because it only includes what has been paid and what has already been received. So what is considered cash for accounting purposes? Cash is the physical money you have in your bank. Physical money you have on your hand in your business, that will most likely be your cash float and your petty cash, and highly liquid short-term investment. So what is meant by the term highly liquid? Highly liquid means that something that is very quickly and easily converted to cash, almost immediately within 3 months. So that would be mostly like your investments or your bank account, current bank accounts, because those are easy to always convert into cash. What is not considered cash is depreciation. Why is depreciation not considered cash? If you think of the depreciation entries, you would debit depreciation and credit accumulated depreciation. It does not touch your bank account at all, and therefore it is not cash. Bad debts is not cash. Why is bad debts not cash? Think about the accounting entries of your bad debts. You'd have debit your bad debt expense, credit your bad debt allowances. You do not have anything to do with bank, hence it is not cash. Discount allowed and discount received. This is something that confuses learners because it almost looks like I've received money. Why is it not cash? Think about it this way. You've got 100 Rand. You've purchased, say, a book for 100 Rand. You go out, you've purchased your book. But the price on the book says 100 Rand, but you've negotiated with the seller that you'll pay 90 Rand. So you get a discount of 10 Rand. What are you going to pay them? The 100 Rand or 90 Rand? 90 Rand. Hence, your outflow is 90 Rand and not 100 Rand. Therefore, you don't take into account any discount allowed or discount that you've received. Next is your profit or loss on sale of asset. For the purpose of the cash flow statement, whether it's a profit or a loss that has been made, it will not affect your cash flow statement. What affects your cash flow statement is the actual money that you've received. So irrespective of the loss or the profit, the actual money that you have received will go into your cash flow statement. The only time you will not have received money is if you've made a donation or if you've scrapped the asset entirely. So let us now talk about the elements in a cash flow. A cash flow is made up of 3 elements: cash flow from operating activities, cash flow from financing activities, and cash flow from investing activities. Distinguishing between them is very important. Once you learn how to distinguish between them, you would know how to put them into the cash flow. Cash flow from operating activities is any cash flow you receive as a result of the main business of your company. So if you're a company running a stationery shop and you've bought stationery to sell, that's part of your business. Therefore, it's part of your operational activities. If you've paid your employees, that will also be part of your operating activities. Cash flow from financing activities. These are as a result of borrowing money. Also, when you sell and repurchase your shares in your own company, that would be a financing activities. Please be mindful. Financing is only if you have sold or repurchased the shares of your own company. Cash flow from investing activity is when you've actually sold or repurchased shares in other companies. That will be an investing activity. Also, any changes that you make to your tangible assets on your balance sheet, that will be called an investing activity. So for example, if you've purchased a vehicle or any long-term non-current asset, that will constitute investing activity. So let us now talk about the format of the cash flow. The cash flow is divided into 4 parts: the cash flow from operating activities, investing activities, financing activities, and the net change in cash and cash equivalents. The last part is the reason that you actually do your cash flow. The last part tells you what your balance was at the beginning of the year of cash, the balance at the end of the year of the cash, and the net movement of the cash during the year. The first 3 parts of the cash flow will assist you in understanding what the movement constitutes. So the 101,148, the net change in cash and cash equivalent, actually is made up of because you've bought shares, you've bought assets in the company, you've paid tax, you've paid dividend. That is the three parts actually tell you how you get to the 4th part of the statement. The cash flow from operating activities constitutes of the cash generated from your operations, your interest, your dividend, and your tax that you've paid. Please do not ever combine the interest, dividend, and tax that you paid. These are all required to be shown separately on the face of the cash flow statement. The cash flow from investing activities will have your non-current assets that you've purchased, the sale of your non-current assets, and any investments that have matured or you've repaid. The cash flow from your finance activities constitute the issue of your shares, any money that you've borrowed from the bank, or any money that you've repaid the bank. So let us now look at how you reach to the cash generated from operations. The cash generated from operations is made up of 2 parts: the profit before tax part and the changes in working capital part. The profit before tax. So the reason you use the profit before tax is because you actually disclose your tax separately in the cash flow, as you've seen in the prior slide. Interest paid is also removed. The reason interest paid is removed is because interest paid is a financing activity. So if you leave it in your operational activity, you are duplicating it, and we do not want to do that. Depreciation. We remove depreciation because depreciation is a non-cash item. So you'd like to get to a profit before tax that is only cash, that is not presented anywhere else. Thereafter, you'd work on getting to your changes in working capital. The changes in working capital will be discussed in the next slide. So changes in working capital constitutes your current assets minus your current liabilities. And I'm using the most common current assets, which are your inventory and debtors, and your current liability being the creditor. And most students get overwhelmed calculating the changes in inventory, the changes in debtors, the changes in creditors, and that is because they're trying to learn this thing. And the approach to do this is rather to think it through than just learning what must happen with inventory, debtors, creditors, and this logic will be able to, you can apply this logic to any of the other current assets, current liabilities that you have in the exam. So let's look at inventory. Inventory is an asset, and you can use this principle for any other of your assets that you have in the question. If inventory is more than what you had last year, that means you've bought more this year. If you've bought more this year, you've spent more money this year. If you've spent more money this year, it's an outflow. If inventory is less compared to last year, you've bought less this year, which means you've spent less money, which means you still have more money, which is an inflow. Same logic on debtors. If debtors is more this year, that means you gave more credit to them this year, which means you have less money, which therefore makes it an outflow. If debtors is less compared to last year, that means you gave them less credit this year, and therefore you have more money this year, and therefore it's an inflow. It will be a positive. Creditors is a liability. If creditors is more this year compared to last year, that would mean you took more on credit, therefore you have more money. Therefore, it's a positive, it's an inflow. If creditors is less compared to last year, that means less credit was taken, and therefore you've got less money, and therefore it's a negative, it is an outflow. So let us look at the same logic at the bank note, which is your note 2 in the cash flow statement in this example. If you look at last year, your first line, bank, you had 112,000. This year you've got 10,000, which means you've got less money this year. You would therefore have a negative answer. It is always, remember, it's prior year minus your current year. Last year you had 500. This year you've got 800. Do you have more money or less money? You've got more money. Therefore, it's a positive. Petty cash. Last year you had 200. This year you've got 500. Therefore, you've got more money this year, and therefore your answer is a positive. So let us now look at your dividends paid note. The dividend paid note will tell you the cash amount of dividend that you've paid by the end of the year. For that, you require to see what is declared in the current year. That will always be a negative. Then you require what is owed from the prior year. That is on your balance sheet. That is also a negative. That is your balance at the beginning of the year. Then you have to see what the balance is at the end of the year, and that will always be a positive. If you add these three up, this should give you the negative cash dividend that you've paid for the year. So let us look at some examples to see if you can determine whether it is an inflow or an outflow. Land and building. Last year you had 450,000. This year you've got 520,000, which means you've bought more land and building this year, and therefore you have an outflow of money. Therefore it is a negative. Ordinary share capital. Last year you had 400,000. This year you have 500,000, which means you've issued more shares. When you issue more shares, you receive more money. Therefore it's an inflow, and therefore it's a positive. Vehicles. Last year you had 100,000. This year you've got 65,800, which means you've got less vehicle this year, which means you've sold more vehicles, which means you have more money. Therefore, it is a positive and an inflow. Equipment. Last year you had 25,000. This year you've got 35,500, which means you've bought more equipment. Therefore, you've got less money and therefore it is an outflow. Inventory. Last year you had 60,000. This year you have 84,000. Therefore, you have more inventory this year and you've spent more money. Therefore, you've got less money and therefore it is a outflow. Debtors. Last year you had 30,000 debtors. This year you have 19,600 debtors. You have less debtors. Therefore, more people paid you and therefore you have more cash of 10,400. Therefore, it is an inflow and therefore it is a positive. Creditors. Last year your balance was 26,750. This year your balance is 18,250. You've reduced your creditors' balance. Therefore, you've paid more this year and therefore it is a negative and it is an outflow. A long-term loan. Last year your loan was 55,000. This year it's 60,000. You've taken more loan from the bank and therefore you have more cash. A fixed deposit. Last year your fixed deposit was 10,000. This year your fixed deposit is 30,000, which means you've invested more money in your fixed deposit. Therefore, you have less cash. Your accrued expenses. Accrued expenses is a liability. Last year your liability was 5,000. This year your liability is 3,000. Therefore, it is an outflow of 2,000. Your accrued income. Last year your accrued income is an asset. You had an asset worth 7,000. This year you've got an asset worth 1,000. Therefore, you've almost disposed your asset to receive an income of 6,000. Income tax. Last year your balance was 15,000. This year your balance is 10,000, which means you've paid SARS 5,000. Therefore, it is an outflow. A bank. You've got a bank balance, a debit bank balance of 15,000, and this year you've got a bank balance of a credit 25,000, which means you have an outflow of 40,000. Why? Because you had 15,000 Rand in your bank. Now you've got a credit of 25,000, which means you spent the 15,000 and you spent the 25,000 Rand the bank gave you. Therefore, it's a cash outflow. Let's look at another example. In this example, we will see if we can distinguish between elements. At the beginning of the financial year, ABC Limited had 10,000 Rand cash in the bank. During the year, they received 820,000 Rand cash. Year under receipts, they tell you what the 820,000 is made of. 440,000 was from operating activities, 240,000 from the issue of shares, and 140,000 from the loans raised. On the other hand, payments, operating activity 276,000, fixed assets that were purchased were 98,000, loans that were repaid was 170,000. Going back to the receipts, 440,000 are operating activities because it tells us it's from operating activities. The issue of shares will be financing activities and therefore the 240,000 will go into your financing activity line. The loans that you've raised for 140,000 is also a financing activity and therefore it will also go into your finance category. Your operating activities into your payment will go into your operating activity line because it is part of your operations. Your fixed assets that you purchase is part of your investing activities and therefore that will go into your investing category. The loans that you've repaid is once again part of your financing activity and therefore will go into your finance category. So from our discussion, we can now see if we easily distinguish the elements, we know where to put them in the cash flow statement. The 440,000 minus the 276,000 is the cash flow from operating activities that was indicated. The 98,000 is the assets that we've purchased. The 240,000, the 140,000 and minus the 170,000 relates to the loan that we took, the loan that we repaid, and the shares that we've issued. We're now left to complete the bank part. At the beginning of the year, we were told that the bank balance is 10,000 Rand. We don't have an amount for the balance at the end of the year. So how do we calculate that? To calculate that is very simple. We had the balance at the beginning of the year. We were told how much money we received for the year and how much money we took out for the year. Looking at it from a general ledger perspective, the balance at the beginning of the year was 10,000. The amount that we have The amount that we have received for the year was 820,000. The payments that we made were 544,000, leaving us with a balancing figure of 286,000. Therefore, your bank balance was 286,000 at the end of the year. Also, always remember, if you add the cash flow from generating activities, plus or minus your investing activities, plus or minus your finance activities, it will always give you your net change in cash and cash equivalent. So you could always use that to do a check to ensure that your cash flow has been done correctly. Lastly, let us go through some exam techniques. Always identify your cash and non-cash items clearly on your exam paper. That means highlight both of them with two different colors so that you can clearly see which one is a cash, which one is a non-cash items whilst reading your question. Also identify whether it's an operating, financing, or investing activity. That will save you a lot of time trying to figure it out when you're answering the question. Always compare any information you have for last year to this year, and always prior year minus your current year, and ask your question, has it increased or has it decreased? Do I have more money? Do I have less money? That will tell you the sign that you need to put in front of your answer. Learn the format of by heart. It will not change. Always remember the following are done separately: your tax, your interest, and dividend, or I call them the TID. Lastly but importantly, we are still here for you. Drop us a mail if you have any questions. Subscribe to our YouTube channel. Follow us on Instagram so that you know when our latest lesson will be up. Feel free to ask questions in the WhatsApp group. Please, please, please share this video as much as you can so that everybody can benefit out of this. Please email us to let us know how handy these notes were. Thank you so much for watching. Until next time, take care. Bye.